Accounting is the process of identifying, measuring, and communicating of financial and non-financial information about economic entities. There are 4 types of accounting process. First, identifying refers to determine what transactions are to be recorded. Second, measuring refers to enumeration of business transactions into financial terms by using the monetary unit as a measuring unit. Third, interpreting process of analyzing account in detail that is easily understandable to determine the business activity that had been recorded. Lastly, communicating information. Process of communicating the result and conclusion to the interested user in the form of a various statement for decision-making purpose. Next is users of accounting information. Users of accounting information can be divided into 2 categories, namely internal users and external users. Internal users represent cost accounting and management accounting that provide accounting information for internal parties within the organization, such as owners, manager, employees, and internal auditor. Cost accounting and management accounting is concerned with ascertaining, analyzing, and reporting of cost and revenue information for planning, control, and decision-making. 4 external users represent financial accounting that provides accounting information for external parties outside the organization, such as bankers, supplier, creditor, customer, and government agencies. Financial accounting is concerned with the preparation of a set of statutory reports that highlight financial position of a firm. The main function of financial accounting is bookkeeping, which is recording of past transactions such as expenses, revenue, assets, and liabilities. Impact of IT. Impact of information technology on management accounting is cost saving. IT improvements such as the use of computerized systems in management accounting are much easier and reduce costs than using other forms of data filling. Also, they are overall more efficient. By applying technology to accounting system will minimize errors during the process of collecting, processing, storing, and making report. This will also minimize the cost for overcoming such errors. Next is safety. Once data is entered into a computer, it is secure. The chance of data loss are impossible, especially when perform regular system backup. With the improvement of information technology, you can save data on the internet. Also, it remains safe. The other impact of IT on management accounting is accuracy. Accounting work require high level of detail and accuracy in recording and reporting. Technology has had a positive impact in accounting application because calculation performed by computer programs suffer from very few errors. Lastly is time saving. Use of IT such as computerized system in management accounting enables fast data retrieval. With a computerized accounting system, information or report for a specific period can be compiled quickly. Computerized system can also provide instant reports, again allowing for faster adjustment in business strategy.
Next, we move to the interface between cost accounting and management accounting. In the first place, cost accounting generally focuses on cost computation, cost control, and cost reduction. Meanwhile, management accounting offers decision-making, strategy planning, performance management, and risk management. Cost accounting is used for management, shareholders, and also stakeholders, compared to management accounting, which specifically focuses on management. Furthermore, cost accounting keeps a company's expense within its budget, while management accounting provides a broad overview of the ideal management strategy. One last thing to note is that cost accounting can be implemented without management accounting, while management accounting depends on cost and financial accounting for efficient adoption.
Financial accounting and management accounting are different from each other. To begin, financial accounting differs from management accounting in how the former school of financial accounting is to provide general information on the company's financial position, whereas the objective of management accounting is to provide information for stock valuation, decision-making, planning, and control. External users of financial accounting include creditors and shareholders. Meanwhile, the users of management accounting are the company's internal managers. That financial accounting follows the regulatory requirements like GAAP for report. Management accounting has no prescribed format because it is not mandatory for the report. 4. Information on financial accounting is supported by notes to account for external users. On the other hand, management accounting uses both financial and non-financial information that are strictly for internal decision makers. Then, for financial accounting, the reports are prepared at the end of the financial year. In contrast, the report for management accounting are prepared on a weekly or monthly basis. Next, the audited accounts for financial accounting are signed and filed annually. For management accounting, the reports are presented to the board members on a monthly basis. All the information for financial accounting is concise about the overall financial performance. Meanwhile, management accounting has more detailed information about the products and department. Following that, financial accounting information systems are historical compared to management accounting forward-looking. Lastly, financial accounting records costs according to cost function and cost unit. Management accounting records ledgers for expenses, income, assets, and liabilities.
The role of management accounting is traditionally concerned with the provision of the information for three broad purposes. First, inventory valuation and profit determination that involve product costing and the preparation of the statement of profit and loss. Second, decision-making, short-term decision-making. The last one is planning and control that involves short-term and long-term planning and control. The role of management accounting has evolved over the years. Over time, several contemporary management accounting practices have been introduced with the aim of promoting value creation for businesses. The decision-making process, which is intertwined with the planning and control process, is basically concerned with choosing the best alternative from a range of competing alternative courses of action. In any organization, the decision-making process is continuous. Each decision begins with the planning and ends with the control. The decision-making process generally involves the following key steps. First, define the organizational goals or objectives. From an economic perspective, an organization may aim to maximize shareholders' wealth. Second, identify alternative courses of action. Identify a range of alternative courses of action that supports the defined organizational goal. Third, analyze data on alternative courses of actions. Analyze and measure each course of action from a cost-benefit perspective. Fourth, select the best course of action. Based on the analysis in step 3, select the most appropriate action plan that will best satisfy the organizational goal. Fifth, implement the action plan. The chosen action plan forms part of the firm's budgeting process. The last one is feedback control. Once an action plan is implemented, it is important to monitor and control. Control involves comparing actual outcome against planned outcomes and taking corrective action to ensure that the firm's original goals are achieved. The process of comparing actual against planned outcomes is referred to as feedback controls.
Hello and Assalamualaikum everyone. My name is Nik Nasafwani binti Nik Muhammad Zaki. My matrix number is 067948. Today, I would like to talk about the changing role in management accounting. There are 4 steps in changing role. Stage 1 is the stage of cost determination and financial control. Cost accounting was developed as a result of quick advancement in cost accounting theory and methods between the 1880s and the mid-1920s. Information on cost accounting was initially produced so that products' costs and profits could be calculated. However, over time, this function has changed to incorporate elements of control planning and decision making. Yearly domestic structural system in which the owner had total control over the manufacturing process was where product costing and profit estimation first emerged. The fundamentals of calculating product cost and profit also serve as a guide for the broader role of organizational planning and control during the start of the 20th century. The management accounting function included the introduction of planning and control tools, including standard costing and deviation reporting. While variance analysis is utilized for cost control, standard costing plays a significant role in production planning. The fundamentals of US and English government budgeting processes serve as the foundation for business budgeting. Unlike conversational costing budget control system, providing cost data for decision making is the last evolution of yearly cost accounting data. The division of costs into fixed and variable components has positive effects on short-term planning and control as well as decision making. The second stage, known as the transition to managerial accounting, began in the 1950s and involved a change from technically oriented tasks to management-focused duties. The development of a multi-tiered organizational structure during this time period aided in the advance of accounting information. The development of a multifaceted organizational structure was a factor in the advent of accounting information. In order to make better planning and control decisions, central management primarily relies on stage 3 is the reduction of waste in resources used in business processes through the use of process analysis and cost management technology. During this time, the Japan's manufacturing sectors, which employed quality as its primary competitive advantage, played a major role in advancing management accounting. For instance, the development of the novel idea of strategic management accounting (SMA) in the West was influenced by Japanese industrial efforts to accomplish strategic organizational objectives, particularly in the area of cost reduction. Just-in-time inventory system, total quality control and computer integrated manufacturing were the three key advances that Japanese companies that lead the globe in quality management during this time concentrate on CIM system. From a strategic standpoint, development at this level paved the way for target costing and cost-cutting initiative to move from manufacturing to the design and development phase. The widespread usage of this SMA approach is in stage 4, which is heavily focused on the efficient utilization of organizational resources for value development. Emerging strategic management techniques like value-based management and quality management practice had a significant impact on the development of management accounting during this time. The utilization of creative methodologies that stress external organizational issues like global competitions set SMA apart from earlier accounting methods. Both internal and external factors have an impact on SMA approach. Life cycle costing, benchmarking, and supply chain management are examples of SMA techniques types that are affected by external variables.
The importance of ethical behavior for manager and management accountant. First thing is, manager must also provide a good role model by being ethical and honest at all times. telling the truth, admitting the failure, and not trying to cover it up. It is also important to have communication share ethical value to the employees through the symbols and slogan, rewarding the employee who behave ethically and punishing who does not. The four standards of ethical conduct in management accounting. The four standards are competence, confidentiality, integrity, and credibility. First and foremost, credibility is a key standard that is based on an accountant communicating information with fairness and objectivity, disclosing all the information that is relevant to the intended users to understand and disclosing. The second one is competence. Competency in accountancy range from basic bookkeeping and communication to problem solving and the financial analysis. Also, skilled financial and managerial accountant will be able to recognize and deal with the complex issue while being able to effectively communicate their finding to others in the organization. The third one is confidentiality. Keep information confidential except when disclosure is authorized or legally required. Inform all the relevant party regarding appropriate use of confidential information. Monitor subordinate activity to ensure the compliance. Also refrain from using confidential information for unethical or illegal advantage. The last one is integrity. To mitigate actual conflict of interest, regularly communicate with business associates to avoid apparent conflict of interest. Advise all the parties of any potential conflict. Refrain from engaging in any conduct that would prejudice carrying out duty ethically. Abstain from engaging in or supporting any activity that might discredit the profession.